Hello, everyone. If you are a sole trader running a business from home and you also have rental income, especially from a UK room rental or an overseas property, this video is for you. A lot of people in this situation think my setup is small, so my tax must be simple. But in reality, this is exactly where small mistakes can become expensive. Let's take a very common example. You are a sole trader, maybe running a small IT business or another service business from home in the UK. On top of that, you have got two property income streams. A room in your own home that you let out on a short-term basis, and an overseas property, for example, in Spain, where local tax is already being handled. At first glance, that sounds manageable. But once tax comes into it, there are a few important questions that can affect how much you pay and whether you stay fully compliant with HMRC. First, there is an issue of foreign property income. If you have a rental property abroad, you may still need to report that income in the UK through self-assessment. Usually on the SA 106 foreign pages. And if tax has already been paid overseas, you may be able to claim foreign tax credit relief. So the same income is not taxed twice. That's where good accounting sport really matters. Because it's not just about entering figures, it's about making sure the overseas income is reported correctly, converted properly, and matched to the right UK tax treatment. Second, if you are renting out a room in your own home, many people assume it's either fully exempt or automatically covered by rent a room relief. Sometimes it is, but sometimes it is not that simple. You need to look at whether the room is in your main residence, whether it's furnished, how the income is received, and whether the tax treatment should fall under rent a room relief or standard property income rules. And if you have been told by your mortgage lender that it does not count as a formal letting because you live in the property, that may help from a lender perspective, but it does not automatically decide the tax position. Third, there is the question of jointly owned property. If a property is owned jointly with your spouse, many people assume they can just choose who declares the income. In most cases, that is not how it works. For married couples, rental income is often taxed 50-50 by default, unless the ownership structure and declaration support a different split. If one spouse is a higher rate taxpayer, Getting this wrong can mean paying more tax than necessary, or creating issues later if HMRC asks questions. Then there is making tax digital. A lot of sole traders and landlords are now asking, when does MTD apply to me? Do I need software? Will I still file self-assessment in the same way? If you have got self-employment income and property income, the timing matters. And if your income is growing, it may also be the right time to ask a bigger question. Should I stay as a sole trader, or is it time to incorporate into a limited company? That decision should never be based on hype. It should be based on your profits, your drawings, your future plans, and your tax efficiency. This is where working with a proactive accountant can save you money, reduce stress, and help you plan ahead, not just file forms after the year has ended. At Taxaccolega Chartered Accountants, we help sole traders, landlords, and property owners understand exactly what applies to them. From self-assessment tax returns and rental income tax to foreign income reporting, rent a room relief, MTD, and limited company advice. If your income comes from more than one source, getting the right advice early can make a real difference. Tax does not have to feel confusing when it's explained properly. Thank you.